Let's talk about the news in the big online brokerage space, because suddenly almost all those big online brokerages are going no fee this week. TD Ameritrade, Charles Schwab, and E-Trade all announced that they will completely cut commissions for trades ordered online. Perhaps they were feeling the pressure from newer trading apps like Robinhood, which always pitched itself as zero fee. All of Us is a new investment platform that doesn't just offer commission-free trading. It actually pays customers a dividend for their trading once the app has earned a certain amount. Alan Grujic is the CEO, and he joins us now from San Francisco. Alan, thanks for coming on.
My pleasure. Nice to see you.
So let's start with this news about the big brokerages going no fee. Was this inevitable? And who is this bad for? It's good for customers. Is this bad for guys like Robinhood?
Well, so it's been talked about for a while that commissions are eventually going to zero in the self-directed investment space. And the thing is, while this seems strange perhaps to outsiders, this has always been the case in capital markets that order flow has value. You know, at the institutional level, large banks, when they make markets for their large institutional customers, are trying to make the bid-offer spread. They don't charge any commissions on that because there's value in those relationships and in that bid-offer spread. You want to sell on your offer as a market maker and buy on your bid. So there's been a natural value to that. So it's always been a little bit contrary to the underlying economics that brokerage firms have charged a commission. Historically, before technology really brought down the costs of transacting and you had people on the trading floors and you had people as intermediaries and it wasn't automated, those costs outweighed the value of the order flow. But things have changed now, and so the order flow can be fully monetized. So it's actually logical that the trading costs are negative rather than just even zero. And that's where we're taking our business model, because we get paid for the order flow, as Robinhood does, you mentioned them. And so we're returning some of that to customers. In terms of your question about Robinhood, I would imagine that it is going to be more difficult for them to grow their customer base or retain it, given the more competitive stance of the other incumbents. But at the same time, Robinhood is a very different user experience, very different customer base, and I think they've done a great job on that side. So there's a bit of push and pull here.
Alan, so I understand your point of view here, but when we take a look at these brokerages, so they make a lot of their quarterly revenue from these commission fees. Specifically, if we take a look at Charles Schwab, about 3 to 4% of their quarterly revenue comes from these commission fees. So to me, this seems like a war with no winners, if I could put it that way, because yes, these brokerages have to lower fees to zero, but that's because everyone else is doing it and they're being pressured to, but that squeezes their profit margins. So what does that mean for the investors of these brokerages?
Well, so it certainly does squeeze their profit margins. At the same time, there's a lot of talk about this being the golden age of banking marrying with technology. Banking hasn't quite achieved the efficiencies and brokerage from technology that they've hoped to, but that's going to happen in the next decade, I think. And so while their margins are getting squeezed from this, I think they're going to find further efficiencies. The other aspect of the business model that the brokerage firms has that we're trying to change that's always concerned me is transparency. When you buy something on Amazon for $50, you know that you gave Amazon $50 of revenue, to use an example. The problem with brokerage is when you open up an account, you can't see the revenue streams. And so, for example, we're really trying to unpack that and make that visible by making it available on our platforms as direct information. But my immediate thoughts with the brokerage firms go to, if they lower their trading commissions to zero, what are they doing in interest margin? Or what are they doing in securities borrowing and lending to make up for that? And so they have other levers where they can increase revenues in other areas. And you mentioned Charles Schwab. That's not a huge amount of their revenue, and they have so many other levers to earn additional revenue that I think they are very well insulated. And that's why the other firms like TD Ameritrade and E-Trade have really gotten hurt, because as a proportion of their revenues, it's a lot higher. They have less ways to make that money back.
I want to talk about the hot IPO market that's kind of gotten very chilly. We know that Uber and Lyft, at least they IPO'd, but they stumbled. WeWork tried to and is now postponing that. Given all those facts, what do you think WeWork's path forward is if they actually do want to still try to IPO next year?
Well, so that's a tough question. My concern with WeWork has always been a fairly basic one that's been discussed in the press, but previously, but they have this model where they have long-term liabilities and short-term revenues, and that's problematic. That's sort of business school 101 that's concerning, and I think given that the economy is so far into its expansion cycle, there's some strong possibilities that things slow down People are expecting that next year. And so it's a tough path because they're not profitable now. Their short-term revenues should come under pressure if the economy slows down. So it's tough. I'm not sure how they're going to handle their IPO in the future. That's going to be interesting to watch.
Yeah, I'm not so sure they will go public, but we will see. Alan Grujic, CEO of All of Us, thanks for coming on today.
My pleasure. Thank you.